short range overstatement. You ready for this?
I am.
On Tuesdays,
Sponsored by the CBOE.
on Tuesdays, we do a 0DT segment. This one is a little bit different today. We are looking at whether, if you're doing a one-day trade, should you base it on the VIX, VIX, okay, or should you base it on the one-day VIX? So using volatility index to anticipate the size of market movements helps option traders prepare for possible changes and determines strike placement. So you know how each day, like we say, what is the expected
VIX 1D.
Oh, 1D. VIX 1D. Perfect. VIX 1D versus VIX. So VIX is the 30-day expected move, but you can break it down to a one-day expected move. And we use that to help us determine where to place our strikes. You know, so like if the one-day expected move is, let's say, $20, like I don't know what it was this morning before we opened. We're obviously outside that range.
Sure.
But where was it this morning before we opened?
9. VIX 1D is up 84 cents at 8.98.
That's the actual volatility.
Yes.
Yeah.
So it's going to be half a percentage.
The one day moves, right? So half would be, let's say the expected move there where 52 is 26.
Yeah, right.
26, and we're way outside that range today. But my point is that depending on whether you want to use one day, so VIX 1D or VIX, that's what we're looking at today. Okay, so you get the context here. So for longer dated options, we are used to the fact that the VIX implied moves tends to overstate realized moves. Generally around 80% fall within one expected move rather than 68. So the theoretical expected move, one standard deviation, is going to be right about 68% of the time. But the actual is closer to 80. That's just the nature of the business. If we scale this methodology down to a day and a half day, how does the IV overstatement look with respect to one day? Now, you know so far it's worked great. But the question is, what does that mean? We're going to use 1 year of data in the SPX, and that's every 10 minutes worth of 0-day data. We consider the VIX implied volatility daily expected move using the opening value of the VIX as well as the expected move from open to noon and from noon to close. So we're central time. So it's 3.5 hours to 3 hours, a 6.5 hour day, right? And then we observed how frequently the realized moves were at least 1x or 2x of the expected moves of those timeframes. So
that would be a bad thing.
That's a bad thing.
Selling premium.
Yeah. Right? So how often does this work, and how often is it a bad thing? Now, like today, we opened down pretty significantly. So you didn't have, even though we're 2x of the expected move, you didn't have to suffer.
Putting these trades on intraday, not overnight.
Right. And so we repeated the analysis using the VIX one day, which is like the VIX, but using one-day option prices rather than 30-day option prices. So the one-day option prices are obviously going to have, because they're going to be much lower, so they're going to have bigger moves.
Sure.
And we use the 30-day because that's just, we do everything off the 30-day. But some people do the one day that only trade 0 days. So let's take a look at how all this stuff works. What is the overstatement, all right? Actually, I'll ask you first.
Yeah.
Because you have not seen this. What do you think the overstatement is?
On a percentage basis? I'm taking a shot in the dark. I mean, I 10%.
Okay, so you think that we overstate 10% on the VIX, and what about on the VIX one day? We'll give you a hint. Whatever you said for the VIX, you probably want to double.
Higher.
It's going to be higher.
15 to 20%.
Okay, say 20%.
Yeah.
So, and that's probably around the neighborhood that I would have guessed. Let's go next slide.
But I have no idea.
No, of course. So here it is. So the SPX, if just using the VIX, from open to noon, from noon to close, and then from open to close, it starts at 20%. So it's about double what you thought. So the SPX change greater than expected, which is in line with the normal VIX trades. It's not that much different. The SPX change greater than 2 times expected is about 2% of the time. Today would have been around that 2% of the time. If
you're putting the trade on intraday, you're still inside.
That's right. You're still inside intraday. If we looked at the VIX and expected move, what's interesting here is that the open to close numbers are actually a little bit lower than I thought they would be. The difference between open to noon and then noon to close, because people write to us all the time, they say, what difference does it make if I do noon to close or open to noon? And I'm like, well, I think open to noon is better, but the reality of it is it's not much better.
Yeah. Yeah.
It's like a couple ticks better, literally a couple ticks better. Let's go to
Open to close. If you can hold on to the
good luck.
to the greater losses,
Good luck.
works even better.
Yeah, good luck on that one. That's really hard to do. Let's go to the next slide. So now this is the VIX 1 day. Now when you do the 1 day, because you start much lower, like where you thought it was 10 to 20, this is 40%. The SPX changed greater than expected. Now the VIX 1 day is about half of whatever the VIX is. So this is 43, 45, and 36 open to close. And 2 times greater is 10, 13, and 6. Again, all these numbers are consistent. It is
Again, it really shows you the strength of the market here when it's coming back from open to close. Because if you're going to get a move that's outside the expected move, and volatility is going to expand, you would think it would be to the downside. I think that's why those numbers from open to close are a little bit better than open to noon or noon to close.
Exactly.
In a bear market, I think it would be the opposite.
I don't disagree with you at all.
Yeah.
And I think it's these numbers here.
They're not skewed, but they're going to be. They are what they are from what the market is.
Now we don't use the VIX 1 day, but if you want to use the VIX 1 day because the numbers start much lower, you get a better perspective of like where you're going to place your strikes a little further outside. And there was a lot of research that went into this crazy amount. So over the past year, we have seen frequent intraday reversals. This was visible for a larger number of greater than expected moves in half days than in full days. Especially outlier moves. There have been many days when large before and afternoon movements were in opposite directions. Overall, the VIX 1 day did an excellent job of pricing the daily open to close realized volatility in the SPX. The VIX, on the other hand, had a very similar level of IV overstatement at the daily scale as if it was a 30-day. It's almost the exact same. Remember, instead of 68, it's about 80. Well, instead of this, it's the same thing. It's about 80%. If you were used to evaluating the VIX to make larger dated trades, which we are, that experience can translate to trading zero DTEs, which it has, and that's why it's been so successful for us. If you are new to the world of zero DTEs, but experienced with normal distribution, then the VIX 1 day can provide you a good idea of how much SPX movement to expect in a day. We didn't have the dollar amounts with this, but obviously if you do the VIX, use the VIX 1 day and you take more risk because there's twice as great a chance of moving outside the range, you're going to make more money.